When it comes to the world of investing, there are various traps investors need to avoid, but there are also certain steps that can greatly increase the chances of investment success. Here are my top 3 golden rules for fund investors. My first golden rule, diversification, doesn't sound very exciting. However, having a well-diversified portfolio is the best way to give your investments ample opportunity to grow, while at the same time guarding against serious short-term losses. Diversification is achieved by investing in different assets, mainly shares, bonds and property, as well as different regions and different investment styles, such as value and growth. You could also include some commodities, such as gold. However, investors need to avoid the pitfall of over-diversification. This is known as diversification and happens when you buy too many funds that are very similar. For example, owning several UK equity income funds. Doing so runs the risk of replicating the wider market. You can do that much more cheaply through a passive fund such as an exchange traded fund, an ETF. To avoid this, you need to ensure that each fund is bringing something unique to the party in terms of how it invests and what it is investing in. If you have more than 20 funds, it'd be a good idea to take a look at them all and ensure each one is pulling its weight in terms of performance and that they are sufficiently different from one another. My next golden rule is to invest regularly rather than all at once. One of the key benefits of investing regularly is what's called pound cost averaging. By investing each month, you benefit from times when stock markets are falling because you are able to buy more units in a fund or more shares in a company. This removes the risk that you can put all your cash into the market just before a nasty dip. Investing regularly doesn't always work in your favour though. When markets are buoyant, lump sum investing usually wins out over a regular investing strategy. However, it is difficult to predict stock market behaviour with any great accuracy, and so timing your investments precisely is very difficult. By investing regularly, the decision is taken out of your hands. Over time, the averaging effect of regular investing reduces the risk of getting market timing wrong. My final golden rule is to reinvest dividends by picking the right fund share class for you. The power of reinvesting dividends makes an enormous difference to long-term investment growth, as the effect of compounding works its magic. Compound growth refers to the way that investment returns themselves generate gains. The effect becomes even more powerful when compounded growth is bolstered by the reinvestment of dividends. For long-term investors looking to benefit from the wonder of compound interest, pick the AC share class, which stands for accumulation. AC means it will reinvest the income generated by the fund's underlying investments back into the fund.